We've talked about Patriot Theaters. They own and operate movie theaters all throughout the Mid-Atlantic. And one of the things that managers are considering is expanding into New England. And in order to decide whether or not that's a good move for the company, they would want to conduct capital budgeting analysis. Is this a good project? And in order to do that, they would figure out the NPV and they would figure out the expected cash flows, project those, and then discount it by the appropriate rate. And a critical part of the analysis is to figure out what is that rate? What is the cost of capital? What is the discount rate that we want to use for this project? And so when we look at cost of capital, we're going to look at it within the context of evaluating a project. It's something we've discussed throughout the semester. However, the ideas and the concepts that we're going to be talking about are relevant for a lot of elements of finance. They get used for valuing entire companies, valuing divisions and units within a company, and so this is commonly applied. It gets used in other finance classes as well. We're going to focus just on projects because we spent a lot of time this semester on projects, but it's widely applicable, the concepts we're going to discuss. We're going to consider cost of capital as an annual rate to keep things simple and focus our work. No reason why, if you had a project where it made more sense to look at things on a quarterly basis, you could come up with a quarterly cost of capital. One could easily annualize that, but we're just going to keep everything annually so we can focus on the cost of capital issues and not the annualization issues. Therefore, in cost of capital analysis, we look at stocks and bonds and their returns. When we have stocks, they're going to pay annual dividends, and when we have bonds, they'll pay annual coupons. Again, it's not necessary. You can always annualize the rates, but in order to keep things simple, that's how we're going to do things. So again, what is the cost of capital for a project? We have a project with a certain level of risk. We then identify stocks and bonds and other financial securities that have the same level of risk. What's the expected return on those financial securities? And that's the cost of capital for the project. And sometimes it's called the opportunity cost of capital because, if here's our project and here is our financial securities and they have the same risk and you've got a pile of money, if you put the money into the project, you're giving up the opportunity to put the money into those financial securities and earn this expected return. So therefore, by pursuing the opportunity of the project, you're giving up the opportunity to earn the expected return associated with the financial securities. So the question that we're going to answer, or at least provide some answers to, is, as a financial manager, how can one figure out the appropriate cost of capital for a project? It's easy to draw a little picture like this, but if we have a project and we want to get the appropriate cost of capital for that project, it's useful to have some tools that can actually be applied, and that's where we're headed.